Hey fellow traders, today's video we're going to kind of extend on the last video I just made with two-pair hedging. It kind of extends further into the concept of correlation, and we're going to actually create a much stronger hedging type setup with using three pairs versus two, because it will be a lot easier to manage and has actually a much better and predictable outcome. So we're going to go ahead and get started into what basically three pair hedging is. And basically, it's kind of sometimes referred to as a trident, circle hedging, or even a tuplet or a triplet. And basically, what it is where you take three currencies and you make three pairs out of it. And then you basically trade those three pairs based on the correlation between all three pairs. And there's actually a pretty easy setup that we'll get into in just a moment. But just a quick review on correlation. Basically, it's something that will go between -1, 0, and 1. Basically, where if the correlation is -1, that means they're doing exactly the opposite. If price, for example, is going up on one, if price is going up on one, for example, it'll be going down on another. If it's none, they'll be kind of sideways. Maybe one might be going up and one might be going sideways. They're just not going to be doing the same thing at all. And when they're similar, when one is making an uptrend, one is probably going to be doing the same thing. So the closer they are to one, the more similar they'll be. The closer they are to -1, the more opposite they will be. And the closer they are to 0, they're just not matching at all. So let me clear this out, and we will take a look at first some examples, and then we'll talk about what the actual formula is, which is actually fairly simple, to actually get a determination of how we're going to figure out which ones we're going to sell and which ones we're going to buy. Now these are all correlation dependent. If you want to snap a quick screenshot, let me turn on the zoom real quick and we'll take a closer look at this all together. So basically what we're going to be doing is, let's say for example we were wanting to buy the Euro USD. So we'll come and let me swap my color here. But if we wanted to buy the Euro USD and we wanted to create a three-way hedge, we would and we could pair this up with the USD CHF, for example. So we would also want to buy this pair and then sell this pair, the Euro CHF. And basically it makes a full circle between all three pairs. So you see the Euro, the USD, and the CHF. So you take the Euro, the USD, and the CHF, and you make three different pairs out of each one. So you have a Euro USD, a USD CHF, and a Euro CHF. And you would do that similarly if you were to trade this with the yen and the US dollar and the Euro USD. So you'd just make the Euro USD pair, make a pair with the USD JPY, and then you would link the two that are not in this one. You would link the one that's not in this one, or in either one of those together to make a pair, and that would make Euro JPY. So basically the way the chart would be read is, let me see if I can get this out of the way without messing it up. And basically the way you'd read this chart though is, if you were going to buy, you would just read it from top to bottom. So you would look at the pair you would look to buy, and then you would, not sure why it's being difficult with me right now. I might have too many things open because I've got a couple of tabs and things like that. So bear with me just a second. Sorry. Get some of this stuff out of the way. There we go. Okay. So if we were going to look to buy on any of these pairs, we would also want to buy this pair in this column and sell in this column. So if we were on the Euro USD and we were looking to sell, though, for example, we would come from the bottom up. So Euro USD, if we were selling that, we would want to sell the USD yen and buy the Euro yen. And what this is going to do over the long term is actually create an effect where you're going to wind up basically having, you're basically going to have one pair go into a gain, another pair possibly will go into a smaller gain, and another pair go into a loss. And what's going to happen is these two will kind of balance out, and maybe part of the one that did make a gain will also cover this loss, but the net result will actually be a positive. So I've actually got a kind of a quick example pulled up. Let me see if I have it still handy. There it is. 1 second to go on this here. Because I know some may start to look at one or two pairs to be with a large drawdown, for example. So we'll kind of take a look at what this little example here, we'll kind of leave it up like that. So basically what you're going to have is one pair may be in a loss, for example, of $2,910, but then you'll have another position that's in a gain of 3,667, and then you'll have another maybe in a small loss of 558. And after you close everything out, because once you decide you're wanting to close out this hedge, you would close all three pairs out together, and this would actually make a net result in the end somewhere around close to a positive $199. So just something to keep in mind. So like maybe you have this one here that has a great gain, and then for example the next one would end up maybe kind of going flat, maybe being down a little bit, and just not really doing much, but one will go completely opposite of the other due to correlation, and the whole effect of everything together works to balance out to actually make usually a net gain over the long term. But this is one of those strategies. It can take a long time to see profits. So that's one thing to look out for when trying to approach this style of hedging. It is good for a long-term portfolio setup, but this is one of those where you're going to have to basically give it quite an extended period of time. And when I say extended period of time, you're looking at, a couple of months, maybe 3 weeks to a few months to realize some actual profits. But it is usually more than likely going to come out in your favor in the long run, and it's one of the most it's one of actually the safest ways to apply hedging. It just seems a little bit more complex because you're trying to figure out this correlation, that correlation, so on and so forth. But I've actually got quite an easy way to work everything out to where you can easily figure out, okay, this pair, that pair, so on and so forth. This is how we're going to do it, and I've kind of made a little bit of a schematic, and we're going to take, for example, let's use the kind of pair setup from the last setup video. We have a USD CAD on one pair, and then we had the Euro USD on another pair. So that's a pair that's not on this chart in that setup. So we're going to need a way to figure out how we're going to balance this out with correlation. And the easiest way is first we have to complete the triplet and actually combine the Euro and the CAD, because that is not a part of either of the other two. So now we have our three pairs, and let me get this going here. So we have pair 1, 2, and 3. And then what we're going to actually look at when we're going to do this is we are going to look for correlation. Now the setup is fairly simple. We're going to have one pair will actually have a negative correlation, and two pairs will have the positive correlation. And this will happen naturally when you set up these triplets. So all you have to know is basically the order for which way. Come on, grab hold of that. Thank you. Oh, there we go. So basically, we just have to know the order of the correlation to know the order of the buys and sells. So between these two pairs here, if we have the Euro USD and the USD CAD, we actually have a negative correlation between these two. And then the USD CAD to the Euro USD, the USD CAD to the Euro CAD is actually a positive correlation. And then also the Euro USD to the Euro CAD has that positive correlation. So anything for this setup, you would actually, let me make sure I have this correct. Anything that is a positive correlation, you will do the opposite to. And anything that is a negative correlation, you will do the same to. So let me make a note of that real quick. Positive correlation, you will do the opposite. And for negative correlation, do the same. So what that means is if you're going to match the EuroCAD to the USD CAD, so for example, in the setup we had there, I was short on the CAD, positive on the Euro USD. In order to set this up properly, we would actually have to sell. Let me make sure I have that correct. No, I don't have that. I don't actually have my portfolio set up the correct way. I was doing something else with that as well. But we have a negative correlation with the Euro USD to the USD CAD, so we would technically do the same. So if we were buying the Euro USD, we would also buy the CAD. So we would be buying we would place a long on both the Euro and the CAD together. And then for the Euro CAD, we would actually place a short. Because then what we would end up having, let me see if I can clean this up and make it a little bit better, easier to see. So get this out of the way and arranged for a little bit better view. Okay. So if we were using the buy example, we would have a buy on our Euro. We would have a buy on the CAD because we're doing the same thing on the negatives. And then we would sell the Euro US or the Euro CAD. And now if we compare that to the CAD or the USD, we're now following that rule of positive. We're doing the opposite of what we have on that pair as a positive correlation. So the way we would actually have to set this chart is we would be setting the USD CAD here. Let me make that just a touch smaller to fit the chart. Okay, we would have the USD CAD there. Or sorry, let me make sure I'm doing this right. Let's work it from top to bottom. So the USD CAD, then we have Let me see if I can do it this way a little bit easier. Kind of hard to set it up to where I can move it all around easily. So we have the USD CAD there. We would have the Euro USD second, and then Euro CAD last. And that's how it would ultimately fit into the chart. So now, if you're looking at these pairs, anytime you're selling the Euro USD, you sell the CAD and buy the Euro CAD. And then if you're selling or if you're buying the Euro USD, you would buy the CAD and sell the Euro CAD. So this is the simple formula, the simple rules. And let me change the background on this so we can be a little bit more in line. So there we go. So anything that's positive, you do the opposite. Negative, do the same. Just keep that in mind. And anytime you're setting up your pairs, it will always work out to where this will naturally occur. So you just have to keep this in mind whenever you're setting up your structure for how you want to hedge. Now, also, keep in mind that it's going to be a fairly slow process in actually making gains, but you are more than likely going to come out on top by actually applying this strategy. It will just take a fairly significant amount of patience. This is not something that's going to basically put your account thousands of percents in gain. But if you are holding certain positions while the market is moving and then decide to cash in some profits and reset, over time you can actually build up a pretty significant amount. But it will, keep in mind, like take 12, 16, 18, 24 months. It could take a few years. It just depends on what your trading outlook is in regards to time. So time is going to be the major factor in how much profit this can actually generate. And you'll also want to monitor your positions. This is not a simple fire and forget type strategy. You'll have to monitor it because sometimes there may be some drastic changes and you may need to adjust the positions or maybe even close it out completely and wait for the market to settle down. You could also have a situation where sometimes this correlation, because the correlation will tend to change. And we'll go ahead and I'll pull the example with that. Let me close this out real quick. And if we're looking, notice this is the correlation coefficient index. You can add that to your chart just by simply going to the indicators and then type CC. It's going to be the first one on there. And then you'll just have to add the symbol. So right now, the way I have this set up, I have the USD CAD, and this one is comparing to the Euro CAD. So you can see the Euro CAD and the USD CAD have a positive correlation. If we look at the Euro CAD, I have it set to the Euro USD. It is positive correlation to the USD, the Euro USD. Oh, I thought I had that one pulled up. There we go. Don't have this one set correctly, so what do I need to set this one to? We're going to set this one to the CAD. That will work. And just kind of cross-checking everything. Let's see. Euro USD, USD CAD. So that one is compared to which one? That one's compared to the Euro CAD. Okay, so this may get a little bit confusing. Now, let me see if I can do some math with it. No, that's not going to work. See if we can do it that way. Nope, not going to work that way. So I will just remove that indicator. But this is comparing to the CAD. Let me add it on this one. It may work on this one. I'll add it again. Basically, you just want to double check that everything is following those rules. A little bit of struggles here, but we'll get through it. Okay, so we have, notice compared to the Euro USD here on the top, the USD CAD is showing positive correlation, but when you compare it to the Euro CAD, it's showing a negative correlation. And now I have the Euro CAD actually compared to the Euro USD, and it's showing the positive correlation. So this setup that I actually have in the paper trading account is not correct. If we pull back up the screenshot, and I really do hope it saved it. Let me get this loaded back on the screen. There we go. It didn't fully save everything, of course. That's okay. We did have the USD CAD here under the cell. We had the Euro USD in the middle, and we had the Euro CAD here. So just jot those back on. So in this situation, if we were selling our USD CAD, for example, we would need to buy on the euro, which is correct, but then, or wait, if we were selling on the USD CAD, we would actually have to be selling on the euro and buying on the CAD. So it does help to kind of work this out by that formula and by those notes. I wish it hadn't erased it all, but basically anything that was doing positive correlation, you do the opposite, and anything that is negative, you do the same. So let me see, let me get this back up here. So just a quick note, positive, same, negative, opposite. Then you have 1 will be negative and 2 will be positive. So this will naturally occur between your setups. So once you just work it out along that formula, then it is being difficult with me again. There we go. So as long as you're following this rule, it will naturally line you up, and over time it should, most cases, generate profits. I have run one test where I had it come out slightly negative, but it was such a small amount that it was almost insignificant in relation to the account. But like I say, just keep an eye on things. If things start to go kind of sideways or the wrong way against the account, you may want to opt to close that out and look for a different combination of pairs. The ones in the chart that are typed in are some of the most commonly accepted pairs and commonly used pairs because of their reliability of working and in conjunction with this type of combination. So maybe stick to the pairs on the list at first, and then once you get a little bit more experience with trading and understanding the markets, then you could start using these rules to structure out your own pairs. Now keep in mind, this is not an exhaustive list. There could be 40, 50, 3,000 different combinations of pairs. Because now you start to include majors, minors. You could also do this with commodities and indexes because of movement value and movement distance that we talked about in the previous videos. So these will still apply here. You could actually take for example, you could buy an oil type stock, and then you could also maybe hedge that out by buying a commodities type contract, and so on and so forth. And it would work that out to your value, as we talked about in the last video. And basically, you can hedge your trades by using other instruments. So this will basically follow the same rule when using other instruments as well. So this doesn't just apply to Forex, it can apply to any instrument in trading. It's even very common to hedge currencies against different countries' commodities. So you may be looking to trade based on a country looking to increase an export of a certain item, but then you may want to hedge your bet against the currency by selling that country's currency just in case that export doesn't come through and the economy fails. So that could be one way you could use this correlation. And one way of using hedging to try to protect your account should the worst case scenario prevail. But then again, keep in mind, once you get beyond combining instruments, still these same rules will apply, but then it gets a bit more technical, especially when it comes to value and time. You kind of have to get something that's going to kind of match in time and movement and speed to value, and that's kind of the trickiest part about it. It's mostly just running the numbers until you get some that match is kind of the best way I can advise to do it. I haven't really come across a real easy formula to work out across uh, instruments, but working with uh, different pairs in Forex, you just simply need to load up the risk calculator and work out your different sizes to figure out your values. Check out the previous video, just get a little bit more detail about that. I'll leave links for everything down below, and I will be actually opening the portfolio account here very soon and coming up live with those trades. I'm just a little bit behind today, but it is the first of the week. I'll do a little bit of a market analysis as well. I think I'm kind of finished up with this paper trading account at this point in time. Let's take a look at where it is. See, it's gaining. Every time I've looked at it, other than once, it's been gaining at some point or another. So if I flatten all these out here, I would gain P&L of 31 cents. But then, of course, you have to account for commissions. So that's another basic trading concept that you should be familiar with is your trading costs, because sometimes when you involve three-pair hedging, it could become an issue of spread. So you may just want to stick to some of the major pairs for making these combinations at first until you start getting into larger accounts and you just want to expand out and increase your portfolio size because you've already got setups in all of these pairs and made other pairs, and now you're looking to expand out even further. The more you diversify, of course, the better off it's going to be in your portfolio, because if something major happens in this lineup, something happens major to the yen, well, all these other pairs that don't involve the yen, like we've got a yen in this pair and a yen in that pair, but these other pairs won't be affected so much. And then, of course, because you've brought in other pairs, uh, you're going to balance everything out, and it's going to ultimately work out to where you stay close to even, or you end up coming out even with a small profit in the end. So just something to bear in mind, though. This is a patient strategy. So just pay attention to those couple of rules, though, and you should be fairly safe. Ignore those rules, and it could be potentially catastrophic for the account. This could hurt threefold if not set up correctly. So just a word to the wise, and word to those looking to keep a tight risk management strategy. Make sure you double check which directions you're going based on those rules, and follow those rules specifically, because if not, it can be extremely detrimental in a very short amount of time, because you're going to be three ways leveraged the wrong way, and then it's going to be three times as painful in the account. So just a little warning to be careful, make sure you understand the instruments that you're trading, and this will ultimately be quite beneficial if you have the patience to wait it out. I'm going to wrap this video up now before it gets much longer, but I appreciate stopping by and watching it all the way to the end. I'm going to get some things set up, get this account going and connected, and get ready to get live here in just a few hours with the opening of the portfolio account. So I'll catch you on the next video.